Good morning and welcome to T-Hub Capital, the Investors Lounge, the podcast where we explore financial market dynamics, emerging trends, and the insights that shape successful investments. Each week, we'll delve into the strategies and analyses that drive our investment decisions. You'll get an insider's perspective on the factors influencing markets and the potential winners and losers of tomorrow. Subscribe to the podcast to stay ahead of the curve and make informed investment choices. Enjoy listening.
Welcome to T-Hub Capital's The Investors Lounge weekly podcast. Today's date is the 6th of July. Let's dive into the week's top market news. European equities rally amid easing inflation pressures and resilient macroeconomic indicators. Over the four-day trading period ending Thursday, the 2nd of July 2026 in US, European equity markets demonstrated solid positive momentum, driven by shifts in the commodity landscape. The Pan-European Stocks Europe 600 index concluded the period up by 1.96% in local currency terms. Investor sentiment was largely supported by a visible decline in crude oil prices over the past month. This downward trend in energy costs fueled optimism that the macroeconomic fallout from the Middle East conflict on global economic growth and inflation might turn out to be more benign than market participants had initially feared. Performance across individual European benchmarks remained firmly in positive territory, though growth rates varied considerably by country. Germany's DAX index substantially outperformed its regional peers, closing the period with a strong gain of 3.69%. Italy's FTSE/MIB also recorded robust performance, advancing by 2.27%. Meanwhile, the UK's FTSE 100 index climbed by 1.38%, and France's CAC 40 index posted the most modest increase among the major indices, rising by 1.07%. Inflation trajectory and monetary policy implications. The Eurozone received encouraging news as consumer price pressures cooled faster than anticipated. The headline consumer price inflation rate fell to 2.8% in June 2026, marking a notable decrease from the 3.2% recorded in May and coming in below the market consensus estimate of 3%. This disinflationary trend was widespread, with price growth slowing down across the region's largest economies, including Germany, France, and Italy. Although the current inflation rate remains above the European Central Bank's official 2% target, the softer-than-expected data is widely seen as easing the immediate pressure on the central bank to implement further interest rate hikes. Retail activity and labor market stability. In terms of domestic economic activity, German retail sales provided a significant positive surprise. Data released by Destatis, the Federal Statistical Office, revealed that retail sales grew unexpectedly by 1.1% on a month-on-month basis in May 2026. This turnaround followed a 0.4% contraction in April and significantly beat consensus expectations, which had anticipated a minor decline of 0.11%. In contrast to the fluctuating retail sector, the broader Eurozone labor market exhibited a high degree of stability. According to Eurostat, the Statistical Office of the European Union, the seasonally adjusted unemployment rate for the euro area held steady at 6.2% in May, remaining unchanged from April's level. However, structural challenges persist within younger demographic segments, as the youth unemployment rate across the euro area was recorded at 14.7%. Outside the Eurozone, the United Kingdom showed signs of steady economic expansion and a resilient property market. Final data published this week confirmed that the country's gross domestic product grew at a pace of 0.6% during the first quarter of 2026. Concurrently, the domestic housing market continued its upward trajectory, with house price growth accelerating in June. According to the nationwide House Price Index, residential property prices increased by 2.2% on a year-over-year basis. While this reflects ongoing momentum in the property market, the actual growth rate arrived slightly below the 2.4% gain that economists had initially projected. Now our insight into alternative markets. Italian M&A landscape. First half 2026 overview and outlook for the remainder of the year. The Italian mergers and acquisitions market demonstrated remarkable strength during the first 5 months of 2026, reaching a total transactional value of $96 billion. This represents a substantial 60% increase compared to the same period in the previous year and positions Italy as a major contributor to the European macroeconomic landscape, accounting for approximately 15% of the continent's total M&A value, well above its historical average of 10%. The first quarter alone established an absolute historical record since 1980, generating $70.3 billion in total value and marking a 78% surge year over year. This explosive growth was primarily propelled by the telecommunications sector and specifically catalyzed by Poste Italiane's prominent offer for Telecom Italia. A defining feature of this period was the pronounced polarization of the market, where a limited number of exceptionally large deals heavily skewed the total volumes while underlying mid-market activity remained comparatively subdued. In fact, approximately 90% of the recorded value originated from just 4 mega-transactions. Among the landmark deals shaping the first half of the year were the ongoing banking consolidation involving Monte dei Paschi di Siena and Mediobanca, the industrial transaction between Iveco and Tata Motors, and the strategic integration of space activities among Airbus, Leonardo, and Thales. Additionally, outbound activity was highlighted by UniCredit's massive $27.8 billion bid for Commerzbank. Financial sector consolidation served as a consistent thematic narrative, drawing in major institutions such as Intesa Sanpaolo, Monte dei Paschi di Siena, UniCredit, and Poste Italiane, alongside a notable $15 billion M&A transaction involving Recordati. In contrast to corporate strategic buyers, private equity firms adopted a more cautious stance compared to the buoyant period of 2021 and 2022. The share of sponsor-backed transactions in the Italian market contracted to just 17%, a sharp decline from the peak of over 60% recorded 2 years prior. According to analysis from Goldman Sachs, this retraction does not indicate structural deficiencies within the domestic market, but rather reflects the tactical difficulty of securing mid-sized target companies in an environment clouded by geopolitical uncertainties, which has prompted many sponsors to defer their transactions. Despite these hurdles, Milan has firmly solidified its position as an increasingly attractive hub for international institutional capital, with numerous global asset managers establishing local operations to capture mid-market deal flows. This trend is underscored by several successful fundraising initiatives, such as Nextalia SGR closing its Nextalia private equity fund at €800 million, exceeding its initial hard cap with widespread backing from over 20 banking and insurance groups, family offices, and pension funds. Similarly, the Coima ESG City Impact Fund surpassed €500 million raised from Tier 1 institutional investors, while Aurora Growth Capital is actively targeting €150 million dedicated to high-potential Italian small and medium enterprises. This deep pool of available capital, combined with the ongoing banking realignment, has rendered fundraising in Italy relatively less onerous than in other European financial centers, providing a favorable backdrop even for smaller funds targeting the medium-sized business segment. Looking forward to the second half of 2026, Goldman Sachs anticipates a more balanced market dynamic characterized by the resurgence of mid-market transactions that were previously postponed due to macroeconomic and geopolitical headwinds, alongside continued cross-border acquisition attempts by Italian corporations. Industry experts from the bank, including Marco Pisotto, co-head of investment banking in Italy, project that the nation will sustain its current economic momentum, leading to expanding M&A volumes, a gradual revival in financial sponsor deployments, and a step-by-step recovery in the initial public offering market. The mid-market expansion in the coming months is expected to be fueled by specific secular trends, notably energy infrastructure, data centers, electrification initiatives, and utility networks, alongside robust consolidation within the healthcare sector. Giuseppe Pipitone, head of Italian M&A at Goldman Sachs, further points out that rising investment flows within the telecommunications space will likely stimulate a steady pipeline of mid-sized deals as the year progresses. Regarding exit strategies, the investment bank identifies two primary mechanisms that will help revitalize private equity liquidity, namely the gradual reopening of public equity markets and the increasing utilization of continuation vehicles, which allow fund managers to extend their holding periods for high-quality assets without being forced to liquidate portfolios in less liquid market conditions. Ultimately, banking consolidation will remain a core macroeconomic theme, as the structural reshaping of the sector is far from complete and is poised to generate further strategic opportunities for both Tier 1 groups and smaller regional operators seeking the scale necessary to support required technological investments.
Thank you for listening to this episode of T-Hub Capital, the Investors Lounge podcast. I hope you found this content interesting and inspiring. If you enjoyed this episode, don't forget to subscribe to the podcast so you don't miss a single episode, and share it with your friends and colleagues who might be interested. To learn more about T-Hub Capital and our activities, visit our website, hubcapital.com. You can also follow us on our LinkedIn page. See you soon. All the best from the T-Hub Capital team.